How to trade in the crypto market goes far beyond simply buying and selling digital coins. Many people purchase assets like Bitcoin and hold them, but active trading requires a different strategy and mindset. Moving from holding crypto to trading it introduces tools, risk management, and timing decisions. Trading is not guessing, it is a structured approach to capturing market movements. And did you know that most beginners lose money not because of bad strategy, but because of poor risk control? Welcome back to New Informative. Today, we are breaking down crypto trading in a simple and practical way. You will learn the core strategies, the tools required, and the mindset that professional traders use. By the end of this video, you will understand how trading actually works behind the scenes, and most importantly, you will learn what separates disciplined traders from those who rely purely on hope. The essentials before you start. Before placing your first trade, you need to build a proper trading foundation. This includes choosing the right exchange, securing your assets, and understanding basic terminology. Skipping these steps significantly increases your risk exposure. Preparation is what protects your capital before profit ever happens. Most failed traders actually rush into trades without setting up these basics first. A reliable crypto exchange. A crypto exchange acts as your trading hub. Platforms like Binance, Coinbase, and Kraken allow you to buy and sell cryptocurrencies. These platforms provide liquidity, trading charts, and order execution tools. Always choose an exchange with strong security and proper regulatory compliance. And remember, exchange security matters more than trading fees. A secure digital wallet. Exchanges store your crypto temporarily, but long-term holdings require a secure wallet. Software wallets run on mobile or desktop devices, while hardware wallets offer offline protection. Hardware options like Ledger and Trezor provide cold storage security. If you do not control your private keys, you do not truly control your crypto. This is why experienced investors rarely keep large amounts on exchanges. Basic market knowledge. Understanding market cap, trading volume, volatility, and liquidity is essential. These metrics help you evaluate risk and potential price movement. Without this knowledge, trading becomes speculation instead of strategy. Knowledge reduces emotional decisions in volatile markets. And volatility is exactly where both profits and losses are amplified. Simple trading types. Spot trading. Spot trading is the simplest and most common form of crypto trading. You buy a cryptocurrency at the current market price and own the asset directly. You sell it later when the price increases to generate profit. The core idea is simple: buy low and sell high. But timing that low and high is where most traders struggle. For example, you buy $100 worth of Bitcoin. If the price rises by 10%, your position becomes worth $110 minus fees. The exchange executes buy and sell orders automatically. Execution speed and liquidity determine how accurately your trade fills. Even small slippage can reduce your actual profits. Day trading. Day trading involves opening and closing positions within the same day. Traders aim to capture small price movements multiple times daily. This strategy requires constant chart monitoring and fast execution. Day trading demands discipline, speed, and strong technical analysis skills. And without strict risk control, small losses can quickly compound. A trader may target a 1 to 3% price increase. Once the target is reached, the position is closed immediately. This process may repeat several times in one session. Consistency matters more than chasing one large win. Many professionals focus on protecting capital before maximizing gains. Risk management and mindset. Successful trading depends more on risk management than prediction. Crypto markets are highly volatile and can move rapidly. Protecting capital ensures longevity in the market. The first rule is never invest more than you can afford to lose. Even experienced traders plan for losses before profits. A stop-loss order limits downside risk automatically. It closes your position when price reaches a predefined level. This removes emotional hesitation during sudden drops. Stop-loss orders act as your financial safety net. Traders without exit plans often hold losing positions too long. Emotional control is equally critical in trading. Fear causes panic selling, while greed leads to overexposure. Both emotions distort rational judgment. Discipline separates professionals from impulsive traders. Most market losses happen during emotional decisions. Doing your own research is essential before investing. Study project fundamentals, teams, and market sentiment. Avoid blindly following influencers or hype cycles. Independent research builds long-term confidence in your trades. Hype fades quickly, but solid fundamentals endure. Conclusion: the crypto market offers significant opportunity alongside substantial risk. Success requires preparation, structured strategy, and emotional control. Start small, practice consistently, and refine your approach over time. Crypto trading is a skill developed through discipline, not luck. Those who survive the market are usually the most patient. Trading is not a get-rich-quick scheme. It is a long-term process of learning and adaptation. Every trade provides data and experience. The key is progress, not perfection. And the market always rewards preparation over impulse. What is your biggest crypto trading tip for beginners? Share your thoughts in the comments below. If this guide helped you, consider supporting the channel. Like, subscribe, and stay informed with new informative. Your financial intelligence grows with every lesson you apply.